welcome back. I'm just coming on quickly and just some announcement to start with. I have been offered this membership function for the channel, which I'm very excited about because usually I think you have to have 30,000 subscribers to be offered membership. So um, it would be nice if some people signed up. Like so far, there's 0 memberships on there. I haven't really publicized it or anything, but I think it's like $1.99 or something. So please support the channel if it's stuff that interests you. And we're going to go right to calendar spreads. Now, a calendar spread in options has to do with buying an option in one month and selling an option in another month. And sometimes it's the same strike. So, for example, the 20 put in one month and the 20 put in another month. Sometimes it's different strikes. When it's different strikes, we might call it a diagonal. And the reason we do this with a calendar is because the closer months to expiration are decaying more quickly than the farther out months. So when you buy a calendar, thus buying the farther out month and selling the closer month, you can have a situation where you're getting paid to have a position on. In this case, it would be a short position. Usually what we do when we're buying a calendar is we pick the strike price where we think the underlying is headed. In this case, we would be picking a strike price that's lower so that because the assumption is that these products all move down lower over time. So let's take a look. Stuff lines up really nicely to do a calendar spread today. And so let's take a look in UVXY and see what we've got here. And I'm just loading up my calendar right now, or my UVXY, and we will go from there. And let's see what we've got going on here. So, yeah, because everything is kind of wacky right now, it's hard to tell what's going to happen, A, and B. Some of these calendar spreads are lining up to be very advantageous in that the closer weeks, the ones that we would be selling, are very expensive. And market trader, I always get crushed in calendars. Well, I would do it small, but one thing you can do, and one thing that I'm going to do, is I'm just going to do a little bit of a calendar spread to get my decay down to 0, and the rest I will just and then but leave my short spread on also. So let me see if I can set up the screen here. My screen is a little bit messed up, but let's see. Window capture. All right, there we go. I had to redo this window here. So here's our window. And we'll set it up like that. There we go. Okay, so let's go to VXX, and we're going to look at the months. And like I said, I have a position in VXX right now. I am long the 2017 put spread a couple months out. But let me show you the calendars that I was looking at here as we wait for this to load. It's taking a second to load in. That's kind of strange. Well, it looks like it's going to load here because other stuff is loading in, but apologies to why this is taking a long time. Well, I can't do it if this isn't going to load in. Sorry for technical difficulties here, folks. Let's see. Monitor. Oh, I know how we can stop this. Ready? Hold on. I can fix this right now. There we go. Bought some VXX puts last week. VXX is fairly stable even when SPY is soaring. Well, it's already gone up. I know, and the reason why it's been so stable is just because the term structure has been so inverted. Okay, so here we go. And when we look at VXX, and let me get out of the way here, you can see on the right side of the screen, and I'm going to close up on this stuff here so that you can see it even better. On the right side of the screen is the volatility of each month. And let me blow it up here. And we can see the front weeks. It says 146, then 116, then 98. But if you look down here till like April, this April is 71. So you can buy a 71 and sell a 98. And that creates an advantageous situation. So if I were to go ahead here and key a calendar spread in, so let's go to April. And if I were to buy the 19 put, so I'm going to click on the 19 put offer. And then if I were to sell this one that expires in 16 days, the 19 put, this spread would cost me 40 cents. So let's say I did $5,000 worth of this spread. So if I bought 120 spreads, that would cost me $4,900. All right, and let's plug this into our analysis. So what I'm doing is I'm going on this trade, I'm right-clicking on my mouse, and I'm hitting Analyze Trade. Now I'm going to go and I'm going to make sure no other trades are highlighted except for the trade we're analyzing. So if I spent $5,000 in buying power here to put this trade on, and I apologize, I need to recenter the screen here. So you can see this trade is in the bottom of the screen here. And what it is it's buying the April 19 puts, the 9 April expiration 19 puts, and selling the March 20 expiration 19 puts. So I'm paying 40 cents for this calendar spread. And when we look up here, we can see what kind of delta it gives us. Okay, so it makes us short 700 deltas here. So for each dollar it goes down, we'll make $700. And 40 cents is very cheap for the spread. And you can see, okay, so if it just stays here, we collect $65 a day. Not bad, right? Collect $65 a day. If it's down 10%, you can see as we move down, the short delta goes down a little bit, but down 10%, we collect $178 per day. That's even better, right? But we have to be aware, if this goes down far enough, we can see down 17%, our delta is flat. And so the perfect situation for us would be that this just rolls right to 19 and sits there, right? Because we would make $2,000. So you can, making $2,000 off of a $5,000 trade is a good deal. A. B, if stuff just sits around here, we're collecting money every day. It's paying us. If this just stays up here and doesn't move, which it seems like it's been just sitting around here for a while, if it just stays up here and doesn't move, we collect $65 a day. That's not bad. As opposed to the trade I have right now, this is a $3,000 trade. Okay, I'm short 465 deltas here, but it's costing me 38 a day, right? So that 38 a day isn't a huge amount. If isn't down a huge amount. That isn't a huge amount if this moves, but if it doesn't move, it starts to add up. We'd much rather be collecting that what was it? Let's see. Let me put this back on. Much rather be collecting that 100 a day, right? For the spread. Now, I'm sorry, 65 a day for this spread. Now, what I was thinking is I could do a little bit of this calendar to kind of flatten out how my costs. So let's say, what if I just did 30 of these spreads and put them in my position with everything else? Okay, so now I've cut my decay down to 22 a day. So how many would I have to do to cut my decay to 0? What if I did 70? Okay, so if I put 70 of these spreads on, I'd have a delta short 800 and it would cost me nothing and I could hang out. So you can mix and match spreads here a little bit. The reason this is so advantageous, once again, is because right now the premiums are so high in the front weeks. And it's certainly possible that right after you put this trade on, they just crush the front week premiums and you make money right away on that. So essentially, when you're buying this spread, you're buying a put out in April and you're selling the one in March to finance it. So if for some reason stuff just sits here, these March puts would expire worthless and you would collect the money you sold them for and you'd still own the April ones for when this goes down later in time. So it's a good deal right here. Look for these opportunities. Let's go to UVXY and see what the implied volatilities look like in there, and then I'll answer your question, Spencer. So UVXY, there isn't that spread as much. Well, there is a little bit. Look here. You could buy April for 130 and sell March for 160. So let's try to queue up a spread in UVXY. Now remember, UVXY is levered, so you might want to pick a lower strike. So what if I were to pick the 17 strike? So I'm going to buy the 17 put in April, and we'll look for the same expiration that March to sell the 17 put. All right, so if I were to do this in UVXY, now it's $1 for the spread. So not quite as, you couldn't do quite as many. So $1 for the spread, so 10 would be 1,000. So 50 would be 5,000. So let's cue that in, $5,000 worth, maybe 48, so that it's under 5,000. And when we look at that, it's not as advantageous in UVXY just because the spread isn't as extreme. So it will give us 300 short deltas, collecting 20 a day. But remember, this moves more. So 300 short deltas might get you more mileage as we move lower. So it's in there as well. Okay, so Spencer, yes, it seems the VIX premiums are extremely high. My buddy was asking why VXX was down 6, but his contract shorts were only up 18%. Well, I'd have to know the exact price of that, Spencer, and what the delta is of the option. Remember, UVXY and VXX operate the opposite of a stock. So as the market rallies and these sell off, volatility will come in, and anything that you're long will go down in price because as this moves lower, the option prices go down. It's the opposite of a stock. With a stock, as stuff goes lower, you've got a skew to the downside and stuff pops. Your puts will pop as the stock moves lower. But because the risk in this is for a spike to the upside, because the skew is to the upside, when the market rallies and this goes down, option prices come in. I wanted to switch from Stinky RH, but the user interface on TOS seems very complicated. Spencer, there are several videos on how to use Thinkorswim, and they also have a good they have good support, but I would check out TheoTrade. I'll just write it here, TheoTrade, because Don from TheoTrade used to work for, I spelled that wrong, he used to work for Thinkorswim, so he has some good tutorials in there. Also, there's a Thinkorswim group on Facebook, which is really good, that you can ask any questions on there, and people are always there to give the answers. Let me see if I can get a link to that Facebook Thinkorswim group. It's very powerful, and I don't know a ton. There's a lot more that I can still learn about Thinkorswim that I don't know. I'm not a super expert on it. I can do what I need to do, but there's lots of other stuff to learn for me as well. So I'm going to put a link here to Thinkorswim Facebook group that gives support for people. And another thing, Spencer, is that Thinkorswim is free. So you can get an account on there without buying anything. Well, Ed, I would make the distinction with calendar spreads. You don't want to do calendar spreads in the VIX, which would be VIX options on VIX futures, right? Because you never want to do calendar spreads on the VIX. And I'm glad you're making this point because I'm going to highlight it once again. There's a big difference between doing calendar spreads in UVXY or VXX in the VIX, because with the VIX, each month is hedged by a different future. So if you were to, I pulled up the VIX on the screen right here. I'm glad that you mentioned this because this is a huge, very important point here. The VIX, here's options in the VIX, right? And these are just options on the VIX futures. And each option month in the VIX is hedged. Sorry, it's off the screen, isn't it? Hold on, let me fix that. Each option on VIX futures is hedged by that individual future. So you don't want to do calendar spreads on the actual options on the VIX. See how I've typed in VIX on the top here? And these are options just on the VIX. So VIX is 31.99, and these are on individual futures. You don't want to do calendar spreads ever on these because each month is hedged by that month's future. The big difference with UVXY and VXX is VXX and UVXY every month is hedged just with VXX or UVXY when you're trading these products. So what we're talking about here is doing calendars in VXX or UVXY. As far as any options on the VIX, you don't want to ever do calendar spreads on the VIX because it's unpredictable what each month's going to do. Each month is trading based on that term structure. And so thank you for thank you for reminding me of that, Ed, because I want to make that distinction. I don't personally trade the VIX at all. I only trade VXX and UVXY, and it's a totally different story than trading options on the VIX, which you don't want to do calendars in the VIX because it's completely unpredictable. Each month has its own underlying. They're different prices, and they move around independent of each other. JD Spence, could you take a look at March 27 put? Call flow into. Do you mean order flow? Let me answer this JD Spence question here. Could you take a look at March 27 put? Are we talking about VXX or UVXY? I'm going to say VXX unless you tell me differently. Okay. So the 16 put, yeah, I mean, I would consider the 16 put to be pretty much worthless at this point. The market's 6-cent bid at 9. I would consider those to be pretty worthless at this point. We've moved so much higher than that strike that they're not really in play. I don't see this. It would be pretty unlikely for this to go. The only way this could go back to 16, I think. I mean, there's a possibility that it could get back to 16, but I would say it's very unlikely that it will get there. Just because with this volatility we have in the market, it's very possible that the VIX, even with a crush, it's 32 right now. It could definitely get down to like 22, but I don't see it going that low. At this point, if you own those puts, since they're such a low price right now, I don't know what your financial situation is, but for me, I would almost rather just hold on to them now if I own them, because in the rare occasion that it did get back down there, you'd be kicking yourself if you sold them out for 7 or 8 cents and then they came back into play. But I think those are basically toast at this point, unfortunately. But once again, if you can afford to not lose the 7 cents that they're worth right now, $7 each, I would just hold on to them probably. I mean, if you had a couple hundred of them, I would just dump half of them. But if you've got like 10 or something, I would just hold on to them just in case it gets a little closer. If we do get a rip down, if this does rip down back to 20 or something, those might come to life a little bit. So I would probably hang on to them, see what happens. But they're pretty much toast, I would think. Yeah, and I would check, folks, at time and sales every day just to see what's going on. I look at that a lot on here. It doesn't all apply that much, but it's going to give you an idea of what's going on. Here's time and sales for the options. And some of this stuff isn't all that relevant, but I would check this out. It seemed like today that vol just the VIX couldn't come in any more than it did. It's great that it came in 5 points, but it just seems like our range is so big. I mean, the amount that we've just moved down tonight since the close on any normal like market would have been huge. Like the Dow's down 200 since the close and Nasdaq's down 70. Everyone would have been like really freaked out, except for the fact that the Dow was up 1,100 points today. So down 200 is just kind of coming off the highs a little bit. So it feels like stuff is settling down. This is pretty much the best case scenario for being short this stuff that we could have had happen. A big rally, and then the rally kind of followed through today. So this is like I said, the best thing that could have happened. VIX down 5. We'll continue to see this stuff settle down and decay, I believe now. Like I said, I've got a short on right now. The 20 right now I have a pretty aggressive short on, which I don't really recommend to people. I've got the April expires in 44 days. I've got the April 2017 put spread on 33 times. But yeah, I do like these calendars. If you missed the first part of the video where I talked about the calendar I've been looking at is the buying the 9 April 19 put and selling the 20 March 19 put in VXX. It costs 40 cents for each calendar, and I think that's a great deal and would help add to a good. Yes, VC analyst. I'm rehashing the calendars thing. The calendar I was looking at is is the 9 April 20 March 19 put calendar. It costs 40 cents, and it gives you some great short deltas, and it pays you every day if we stay here. So there you go. Yeah, VXX has climbed a little bit after hours, but you got to think the reasons for that. We are down. E-mini's down 26 now, and I love the way the spread collapsed by 3 more points today, which is great. That's cutting in half once again the spread, and I think we just have to be a little patient here. Stuff's moving around a lot, but the Dow was up 1,173, so back down 200. It's only given back less than 1/5 of how much it was up today. Same with E-minis. It's backed off a little bit, but it was up so much today. It's just kind of moving around. The risk in the calendars is if stuff moves straight down, way down past the strike, then it's not going to be so great for you. Or if stuff moves way, way up, then it's not so great for you. But there's time with this one, and I think it's a better deal than like buying some puts that are going to waste away. That's a chart SPY versus SVXY. Yeah, that's interesting. It just feels like volatility isn't going to come in that much when we've got a 1,200 point move, even if it's to the upside. But I do think this is good. It feels like we're going in the right direction. I mean, if we were down 1,200, I wouldn't be too happy about it. But when I try to think about this stuff, once again, I like to just back up my charts and see what they look like. In a broader perspective. Here's the year chart, and we see that it's, this is so much of a better chart than if it had continued to just tank, right? And it looks like every day the daily range is getting a little smaller. If we continue to just slowly rally, this stuff is going to come in. This is a unique situation here, and it's hard to play. This is hard to call here. But like I said, when you've got the advantage of a calendar spread right this moment is that the month you would be buying is a low volatility, and the month you'd be selling is a high volatility. So I feel like buying this calendar is safer than just having a short on, because you're going to get paid if it stays in the same area. But, it's really up to you and what your strategy is. This is a tough period of time, and I don't have all the answers for you. But, we can kind of talk about some of this stuff together. How about a long further date? So, yeah, I mean, the reason I picked 9 April is just because the implied volatility is 71 with that. But you could go out to, let's say, July. But then if you go to July, the question is which strike do you use? Now, you could do some sort of split strike. So you could go ahead and buy, like, let's say the July 17, and then you could go ahead and sell the March, even like a higher strike against it. Now, you're putting on some risk when you do that, but that kind of trade can work as well. If we just stay in the same area, you've got, let me get out of the way here. I'm like right in the way. Sorry about that. If you were to buy like the July 17 put, you could sell like the March 19 put against it, and you've got that $2 risk there. But in this case, you collect more. You can mess around. Yeah, the implied volatility is it's all over the board. That's why if you can buy a low volatility and sell a high volatility, it really is advantageous. And the only reason these options are like this is just because I think everything's kind of wacky right now, and they haven't really made this very efficient. So it's perfectly possible that that the stuff comes back in these options that you'd be selling for 100 vol. It's perfectly possible that they crush that back down. Yeah, and there's skew to the upside in it, of course, and it's all wacky. But if you're just doing the same strike, there's not that much worry. No, and Hubers, that's correct. I wouldn't trust the implied volatility figures on Thinkorswim that much. But for me, I can eyeball it and I can say, all right, well, if I'm paying 40 cents, if you're paying 40 cents for a calendar spread, the most you can lose is 40 cents, right? So your risk is 40 cents. If it's the same strike and you're just buying a put spread, paying 40 cents, the most you can lose is 40 cents, and that's a pretty safe feeling to me. So think about it. I know for some people this is going to be a little intimidating and scary, but you should just be looking at this stuff. And to me, when I see something like buying a 72 volatility and selling an 88 volatility, it's a good do. And remember, the farther you go out in time, the more this volatility difference matters. Look at this. There's not enough liquidity to do this, but you could buy June for 60 and sell Jan for 70. That's kind of interesting. Yeah, the bid offer spread was very useful to us, and the thing is that what they do when stuff gets really busy is they declare a fast market, and so you're able to widen out the bid offer even wider, and people come in and pay the market, and you can put great stuff on for great prices. The other thing we were able to do at the SIBO is we were able to fade. So a lot of equities, we were the only game in town. It wasn't dual listed. It was just listed by us. And if they wanted to buy 500 calls, we'd say, okay, if the market was $1 bid at 150, we'd say, okay, well, you want to buy 500 calls? We'll sell you 25 at 150, 25 at 160, and the balance at $2. And then as soon as 3 hours later, we'd take the offer back down, assuming people weren't buying stuff. So we'd move the markets around, and there was kind of easy money back and forth with trade. And when you have a busy stock like a Tesla or something where it's back and forth paper and people are willing to pay the offer, then you can make tons of money. It's much harder now because most people expect to be able to buy stuff almost mid-market. They're not coming in and just paying the offer for stuff most of the time. Way back when, people were not very savvy. They didn't have their own modeling software, and they would just come in and with market orders, and we had wide spreads, and so there was a good portion of easy money to be made just on buying on the bid and selling on the offer. and then moving volatility. You know, if people come and buy stuff, you raise it up so that you're selling it in better and better prices. But the way we can take advantage from home of this stuff is when you see something you can buy for very low volatility and something else you can sell for very high volatility. If you put that trade on, it does actually have edge to you. And by that, I mean you are flipping the odds in your favor when you're able to put a spread on that's like 30 points in volatility. So I wouldn't recommend that people, you bet the farm on this stuff, but just start to play around with it a little bit and have some fun. You know, one of the biggest trades I had last year was in an illiquid stock where before earnings, I was buying a lower volatility and selling a higher one, and I ended up paying $3 for this spread. And the next day, right when the earnings came out and they crushed everything, the spread was trading $7, and I was able to make like $3,000 on a small trade in one day just by buying a cheap volatility and selling a higher one, just because I sat there and looked at the screens. Now, market makers might have reasons for having these spreads like this. Maybe they've already sold a ton of front month stuff and they just don't want to sell anymore. And maybe there's a variety of reasons. Maybe someone's coming in and selling them the farther out stuff and they don't want to buy anymore. But regardless of what their reasons are, if you can see it on the screen, then you can take advantage of it. All right, I don't want to make this too long. I really appreciate you guys checking out. Let me make my pitch once again. I did set up the channel join thing, so if you want to spend $1.99 to join the channel, you're welcome to. Then obviously no pressure whatsoever. But if you want to support the channel, you're welcome to. Yeah, we've gotten some new viewers. I really appreciate that. Appreciate you guys coming on and checking out this stuff. This is a tough situation here. So any way we can put our heads together to figure out how to make some money here is a good thing. And I know it feels better to actually just be with some people who are doing the same kind of stuff that you are. We'll see where we open tomorrow morning. Yes, it is amazing that the VIX futures are climbing once again after hours, even with that huge rally today. But, you can't complain about the VIX down 5 points in one day, really. It's going to take a little while for this stuff to shake out, and it really did go the right way for us today. So, as I said this morning, what we wanted is that spread between the VIX price and the front month futures to narrow, and it certainly narrowed by a lot today. So, it's possible that tomorrow it goes the other way a little bit. I wouldn't be surprised. We've kind of had an up day, then a down day, and maybe that continues. But as it continues, let's get this VIX central term structure back in order with the VIX below these futures and get back into contango, and so we can get back into our games playing again. Thank you for your membership, VC Analyst. It's very kind of you. All right, guys. So thanks for watching, and best of luck. I hope you make some money today and tomorrow, and I will see you again soon. Thanks for watching. You are the first member VC Analyst, so thank you very much for your support. All right, guys, I'll see you again very shortly.